Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I know there was some people asking about, recession. How does it have an impact on commodities? Some things around that. So I'll talk about a recession, what it is, some data on it, and you guys can make your own decisions of where we're at or what's going on. But I'll show you the data and what I've seen in history and kind of explain it from my perspective. So let's just first go over the definition so everybody understands it first. So the definition of a recession is defined as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. And on this channel, I've talked a lot about ratios. And ratios are basically telling us where money's at in the system. And when you have certain market conditions, we'll call it low inflation with low interest rates, or lowering rates of inflation with lower interest rates. What happens is money goes into stocks. They go and seek stocks. And how we can see that is what we do is we go in and we look at a ratio. We go to the CRB to S&P 500 ratio. And I know people, they're probably like, oh, I've seen this already, but maybe some of our viewers haven't seen this. So we look at this ratio and we can tell what's been favorable over time. And this is just a big picture view. Let me get off logarithmic here. So this movement going lower, as this ratio goes lower, stocks outperformed during this period and money went into stocks and not into commodities. That's why the ratio has been declining. Recently, we've shifted in 2020 and 2021 and broke through that downtrend and started moving higher. We very well could have a pullback here. We've got some wicks at the top. We could pull back a little bit before heading higher. This would be basically wave one. And then we're going to have a big old wave three that comes, but which is a possibility. But this has broken the downtrend line. And that means that there's been a shift or a paradigm shift in the market. The new paradigm where commodities will outperform stocks. What that is telling us, it's verifying that the market conditions of an inflationary environment are present. When inflation comes, we have an increasing interest rate environment and money starts to rotate. So that can also, from that inflation and an increase in interest rate, it can have an impact on money flows. And those money flows and how people spend their money in the economy shift into other things. So under this type of scenario, people can't buy as many consumer goods. So money starts to divert towards problem areas. And those problem areas are typically in energy when this happens. We go into an energy crisis and money massively diverts to energy and the cost of energy, and less so against consumer goods. What do you think that's going to do to the economy? The economy starts to shrink, and the sales go down of all non-energy related things. So you get this gigantic shift of money basically going to fewer items in the economy. They're going after basically more needed items, not the wants that people want, because there's less money to go around with the products costing a lot more. So usually you get a slowdown in the economy. And this is happening during a inflationary type move. It's not a deflation type move. Deflation's when things are collapsing. This is happening when things are going up in price. So money's being diverted towards commodities and energy. In a collapse, it's different. That's the money supply collapsing. And when that collapse happens, everything goes down. So we've got basically two different scenarios, at least the ones that I'm aware of, where you have a recession that's inflationary and you have a recession that's more deflationary or a deleveraging recession. I think it's an inflationary problem that we are having, where more money is being diverted towards energy and commodities and food, and less so to the overall market and other things in the market. And we can obviously see that with the commodity to stock ratio that we've been looking at. We can see that with increasing interest rates. Another metric that I like to use is the housing starts. And I can zoom in here real quick. This is the housing starts. This is new privately owned housing unit starts. The dark gray areas are recessions coming through here. And those recessions are usually tied to a declining housing starts movement. These are deflationary type recessions. And they're almost all recessions that are kind of deflationary or a deleveraging in the system. It means there's less money in the system, less loaning is going on in the system, and that's why the housing starts are declining. There's less loans in the system to basically blow up that system. We had a large crash in the housing starts, which was the massive crisis in 08. That's what that recession is here, and our housing starts really crashed before it. Now, we've been going up in housing starts, and usually you don't have a recession as this line goes up. And we've been going up, and we've had basically a small pullback here this past month. It's declined some amount, and we need to see and watch what the housing starts do. If it continues to decline, we very well could have a recession. And that would be a less money in the system. But there's also a credit cycle that's stacked on top of this, where the Federal Reserve might be backed into a corner. And what I mean by this is, I'll just go back to the 10-year yield here. We were going to break this area in 2018. It was October 2018. We were up there trying to break, yields were trying to break out during that time frame. Housing starts were going up. We were trying to break to the upside, and something happened in the market. They did quantitative easing to bring this back down. And they needed an event to bring these rates lower. And you could remember the medical event, the C19 event. Maybe that event, they thought they could bring that on. I don't really know. But they needed something to hold this lower. I know that the rates coming back up about to the same level as 2018, and all of a sudden their asset balance sheet's starting to go up. They're buying something, and it's maybe 10-year yields. But the weird thing that I keep seeing is we have all these problems when interest rates get to around this area. So they're backed into a corner. I don't know how they're going to get out of this. They can't really raise rates more. If they have too much inflation in the system, I don't know how they're going to stop it, which means there's too much debt in the system. It starts to implode. So they're going to have to print a whole bunch of money to keep this thing, basically the wheels on the car, so to speak, to keep this thing running. So going back to the recession comment, I think they're backed into a corner. And I don't know how they're going to get out of it, the Federal Reserve. So we very well could go into a recession, and I think it's going to be inflationary. They're going to have to continue to print money, and if that inflation keeps coming into the system, they're probably going to still have a real negative yield. That real negative yield is going to put pressure on bonds to continue to sell off. So the only real buyer of bonds would be governments at that point. Why would somebody buy a bond if you know you're going to lose money on it if you have a large real negative rate? What that means is the inflation rate is greater than your interest that's being paid on the bond. So no one's going to want to buy them. Only governments, because their sole purpose is to keep the interest rates low, which means they're in complete control of the interest rate. And they're doing that with freshly printed money. So it's going to be inflationary. And every time we get to this level of interest rate, this is where things start to have problems. At least in 2018 they did. And I don't see why it wouldn't be any different today. I mean, we'll find out. So I think that we can have a recession that is inflationary, where commodities, and not all of them, not every commodity, I think some commodities will do very well, especially those that are directly impacting this situation. I'm thinking more on the lines of energy. I think a recession is probably going to happen no matter what, because we are going to be short energy. And that energy shortage won't allow the economy to grow. It's going to have to destroy demand somewhere in the system. And that's not good for the economy. Now, other areas may struggle. Things like industrial base metals may not do as well. Copper, zinc, tin, aluminum, those things may struggle in the short term here. Precious metals may do well. Energy will do well. And food, I think, will do well. I think those areas will do quite well, and I think they'll be pretty resilient because those are where the problems are at. So a recession is a contraction in the economy, and I think we're going to have to contract because we have an energy crisis. And I think that energy will do well. It may be very volatile as people think that demand will be destroyed, and then inventories come back. Maybe they're low, and they're trying to manipulate these inventory guys. They're trying to release oil from the Strategic Petroleum Reserve. They're trying to do all sorts of stuff to manipulate the price of oil as well. Will it be successful? Short term, maybe. Medium term, probably not. So there's a lot of things in the market that are all trying to be manipulated simultaneously. And the way that I'm playing this is, what are the drivers that are causing the problems? That is what I asked my question. And the answer, in my opinion, is energy. Energy is where the crisis is at, and that's going to put inflationary pressures on the system. It's going to destroy other parts of the system where it will collectively be a recession. But the money has to rotate into energy to solve this crisis or problem. At least that's my stance. Is it going to be a smooth ride? It's not. It's going to be very volatile. We're going to be moving up and down because we're basically hitting a limit to a growth, or limit to we're hitting a constraint in the system, and that constraint will hit it back off, hit it back off, hit it back off. It'll cycle through that. And then I think at some point, depending on the realization in the markets and people figuring this out, saying, hey, look, this isn't temporary. This is a lot bigger problem than what we thought. And then I think money's going to rotate into energy in a big way, and into other commodities that are impacted with energy. There's going to be tertiary effects as well. And I think there could be currency problems if the energy problem doesn't get solved. So I've been hanging out in a lot of energy and precious metals type investments. That's what I've kind of based it on. And if you guys are interested in knowing what I own, you can join the Platinum membership in the description link. You can see what I own in my portfolio. I do updates on when I think I'm going to buy something, or if I'm buying something, I give updates to the members. I've kind of just been sitting around on my hands lately, and looking at the markets and watching them to see if we can get a bottom at some point. But yeah, if that interests you, become a Platinum member for sure in the description link. But yeah, I think I've summed it up, at least my opinion on it. And if you guys like this analysis, give me a thumbs up, subscribe to the channel. Definitely stick around if you like my opinions, and we'll catch you next time. This is Finding Value.